Welcome back to Fast Money. Take a look at shares of ServiceNow plunging after reporting a drop in contracts signed in the latest quarter. The once red-hot software stock seeing its biggest decline since March of last year. It's not the only name, by the way, under pressure in the space. Shares of stay-at-home darlings like Zscaler, DocuSign, Zoom, Datadog, all dropping today. Throw in Citrix. That was a big decliner in today's session as well. Dan, you pointed this out, the big moves lower in software.
Yeah, it's interesting, and none of those names that you just mentioned have confirmed any of the new highs in the S&P 500 or the recent one in the NASDAQ 100, and I just find it interesting specifically about ServiceNow. Listen, this is a great company. It has nothing to do with them. I mean, the miss wasn't even that big. The problem is, yesterday it was a $110 billion market cap company trading about 17 or 18 times sales or so. So you clip 10% off of it today because of a small miss. Investors are just saying here that for them to grow into this valuation, they have very lofty growth expectations to get to $10 billion in annual revenues. It's going to take a little longer than they think. And are they willing to pay these sorts of valuations, 100 times earnings and 17 times sales? And the answer seems to be no. So I think you just have to be careful here. On the consumer stuff, people generally don't care about valuation right now. It's about eyeballs and all the other crap that you want to come up with to justify the valuation. But when it comes to the CRM or the SaaS stuff, it can be a little different when I guess the momentum slows down a little bit.
Yeah, and with these high valuations, you throw in a little bit of 10-year yield that was up to 168 or so during this session, and you don't have a cocktail that's working for you, Karen. You're still short IGV, the ETF that tracks software.
Right. So it's, a lot of these high flyer stocks also happen to be pandemic stocks. So when you raise rates like you just cited, then the multiples come down. And then when you have a reopen trade and people flee the sort of, things that work from home, like a DocuSign, not that they can't still grow, they can, but those two things together and high multiple stocks like Dan talked about, they're just unsustainable at that price.
Are there babies being thrown out with the bathwater guy in this basket, though?
Yeah, I mean, Zscaler you mentioned. You look at the massive double bottom in that name in ZS. We talked about it, I think, a couple months ago. I think that's tradable. But, ServiceNow, just to throw a little more fuel on this fire, and they also filed a mixed shelf as well in this thing that I think maybe took the market a bit off guard. It's a valuation story with NOW for sure. And I think that's what got people concerned. So it's not to cast aspersions, as I like to say from time to time. It's just too rich of a stock.
Same question to you, Tim.
Okay. So you want a name. So, look,
Yeah.
I think of some of the names that you have or have not mentioned. How about Palantir? This is a name that was also part of the stock draft today. And I think whether it's enterprise software, in some cases, companies that look like they've dominated a particular corner of the intelligence side of it, I like that story. And I think the valuations haven't made sense in software for a year and a half. The poster child is CRM. That's a terrible chart. Oracle has gone the other way. Oracle is a remade software company, effectively, and that's been a chart you wanted to own. But largely, as we've all said, the high multiple software stocks have been hands off. Palantir, to me, is a stock that also got caught in a Reddit kind of confusion. It's a story where I think you have to see a broadening of their customer base. I think we will, and I think they're in a strategic position to do that.
Shepard Smith here. Thanks for watching CNBC on YouTube.